Now let's get more into these Bernanke comments. Also, this possibility of using TARP funds to create jobs with Jeremy Siegel. He's a professor of finance at the Wharton School at the University of Pennsylvania, and he's joining us from Philadelphia. Jeremy, thanks a lot for joining us. Welcome.
Good afternoon, Julie.
So let's start with this Bernanke speech, first of all. Do you think that this was damage control on the part of Bernanke because markets really did seem to start to assume that the Fed was going to move more quickly to raise rates?
Well, the Fed's actions are very data specific. I mean, we had a great labor market report, and people say, well, if employment's going to start increasing by early next year, the Fed is going to have to tighten sooner rather than later. It's my feeling, I voiced this on Bloomberg, that I do think that by the springtime they very well may have to start moving up that Fed funds rate. But they're not going to commit to that now, and clearly it would be premature for them to make any different indication at this time.
So you think, though, that basically the read that the market seemed to have on Friday and really earlier today until Bernanke talked was pretty spot on, that indeed we could see rates maybe start to go up sooner rather than later?
Yes, I definitely believe so. I mean, I think the consensus is probably second half of 2010. There are many analysts that are saying the first half of 2011. I think that's way too late. And, I think the economy is going to be improving at a rate that will allow Bernanke and company to start raising them modestly by spring of next year.
And so I assume you think that inflation is going to start to heat up as well if the economy starts to get better.
Well, I don't think inflation is going to be much of a threat for a couple of years because we have a lot of excess capacity. We know there's still a very high unemployment rate, no pressure on the labor market. We know rentals are going down. When commercial real estate rents are dropping 20–30%, these are the major cost features of firms. So they're not going to have pricing pressures, I think, over a year or two. But going down the road, once our recovery is in gear, yeah, inflation not at double digits. I think I'm giving 2 to 4% by 2012 and onward, and I think that that will be the level we'll stuck at it for a while.